On Friday, after trending up for the entire week, the indexes made a really kind of dramatic move lower. And of course, in the discourse everywhere, everyone was saying, the market's dumped. What's going on? Of course, it was really just retracing some of the move we made, but it does look really dramatic on the charts. So I was curious as well. And, the news that had come out just as all of this was happening was about Moody downgrading the US credit rating. And, this isn't something that I totally understand. It's not something I need to understand as a day trader, but I was curious and interested. So, of course, I wanted to take a look beyond just the news articles at what was actually going on. It turns out that a lot of this is related to the relationship with the US dollar and its relationship to the markets, which has also changed recently. And so that's another thing that I've been interested in. And of course, they're tied together. And let me interrupt myself real quick to remind you that liking and subscribing is completely free to you and shows a lot of support for me. And as a thank you, I have some ongoing giveaways going on at 𝗂𝗏𝗏𝗏 where you could win some merch and prop accounts and all sorts of fun stuff. All right, let me get back to it. A lot of the times when we're watching the US dollar, it'll have a reverse correlation with the indexes. And what that means is if the indexes are moving up, the US dollar will usually move down. And that's not really on a candle by candle basis. It kind of can be sometimes. Traditionally, it's usually around data. So if we have some data coming out like PMI or any of those sort of data points, unemployment, that can cause the US dollar to have a reaction. And as a result, the indexes will move in the opposite direction. And the reason that happens is the higher the US dollar is, the more difficult it is for the global market to participate in business with US companies, the US companies that are listed in our US indexes, or in our stock market indexes. So in that way, it makes a lot of sense that if the dollar goes down and the value of the dollar is lower, it's cheaper for the other places in the world to do business with us, that, Microsoft and Apple and those sorts of stocks would go up. Lately, that really hasn't been the case at all. In fact, I really haven't been watching the dollar on an intraday basis for making trading decisions. I've really been relying more heavily on the VIX, the volatility index. It's had a great reverse correlation, and the US dollar really hasn't. Another factor at work is the bonds, and specifically the US Treasury bond yields. And if you have the problem of having a lot of money that you need to put somewhere and you want to put it to work because of inflation and everything else, you want that money to be put to work for you and making its own money and its own income. So if you want to put that money to work instead of just having it sit in a box and becoming more and more worthless all the time, you have to put it somewhere. If the stock market sucks, if it's scary, if it's really volatile, like it just was with all of the super dramatic trade war news coming out, a safer place to store your mattress money, the big $1 million problem you have, might be in something like bonds, because that's something that is, is guaranteed by the government. It should be really stout and low risk in that sort of environment relative to the US stock market. So that's when we see the bonds increase relative to the stock market. But it should also kind of have that same correlation with the dollar. So if the dollar is moving higher, the stock market's moving lower. If bonds are moving higher, the stock market is moving lower. So the dollar and the treasury yields should have a correlation there. But what's happening right now is it's not. So if we scroll back a little bit, you can see that in general, as the dollar moves down, the treasury yields move down. And as the dollar moves up, the treasury yields move up. But what's happened recently is the dollar's continuing to dump and lose value, and the treasury yields are increasing. So the term, and you've probably heard this before if you've been around finance very long, but maybe you don't understand it. The term that they use for this is uncoupling. So the US dollar and the bond yields are uncoupling. And when that happens, it's a sign of instability. And that's why there's people that are going to be more risk off right now, which again will help boost the bonds a little bit. But when we see this happening, that's when we start seeing headlines like Moody downgraded the US credit rating. And the reason is because they're seeing that as a signal of instability, that maybe there's something that's not totally right. And that'll get investors' attention too, because they're going to be wondering if that's going to cause the sort of shift in where capital is going, like a flow in capital out of the stock market into bonds or into another asset if the stock market isn't safe and that sort of thing. So that's the drop that we saw at the close on Friday, was a really strong reaction to that news, because there are people who understand immediately what that credit rating means and all of that, because they're really tuned into that, and that's really their strategy to engage with the markets. The things we have to worry about are really the concerns of ongoing instability. And of course, the trade wars have really played into that. But that's not all that's going on. There's been a lot of economic turmoil for a long time now. The global markets really are changing, and how just the markets work and how people react to them. But the whole sentiment is really. And, the equity markets are always really resilient. They're stout. They always spring back. That's why we have the joke about stonks only go up, because they do. That's always the sentiment for equities and everything's to always gain in value. But we do have a lot of volatility right now. And so there is concern about more downturn like the one we just had. Of course, that was very dramatic and based on news, but that is a concern. So moving forward, there are some things that we can kind of look at and just kind of keep in the back plate for understanding. I like to use any extra information that I get that maybe I don't technically need to execute day trades, just as the context that I'm using to interpret the market. So I want to have a general idea of if the market is trending up or down or sideways, and where our potential to break out of that could be, or where we might have some sort of change in the market. And these are the kind of clues that will help guide my much smaller trades on a much smaller, faster intraday chart. It'll help give me confidence in my trades, but it'll also give me potential for some larger swing trades and breakouts and things like that. So it's always really great to have that sort of lens that you're filtering everything through. And right now, something that we need to pay attention to is the 30-year bond yield. And by the way, the ticker for this is TYX, what I'm looking at right here, the 30-year bond yield. And 5% is kind of this magic trigger that they're watching. And you can see we've been there before. This is a daily chart, so we're really zoomed out. But we got there in April, and that's when we were having the really, really worst of the reaction to the tariff news. And here we are again, testing that 5% mark. And that's what people are going to be watching. Is just like any other chart, this is resistance right now. Is this going to become support? If it becomes support, that could potentially be a problem. But if this ends up fading and becoming resistance here, that's going to show that maybe the markets are going to be pretty strong here. So will the dollar get stronger and kind of catch up with yields, or is this kind of a shift that we're going to see where we might have some longer term uncoupling? We need to pay a lot of attention to how the Fed's speaking about this also, because this is definitely something that's going to be really important to the Fed right now. They're always watching the employment data. That's always one of their very top priorities. But I think that when we have bond yields at 5% and this uncoupling with the dollar, and now you know exactly what I'm talking about, that they are going to have concern here, and they're going to be watching this situation really carefully too. So I hope I taught you something about the financial markets today to help improve your trading. So if you want to see more like this, you know what to do. Like, subscribe, do all the things, and I will bring more for you. All right, that's it for today. Love you. Bye.